Strike price, what you pay for stock options. When you join a startup and receive stock options as part of your compensation package, understanding strike price is absolutely essential. It's one of the most important numbers that will determine how much money you can make from your equity. Strike price is the predetermined price at which you can buy company shares when you exercise your stock options. Think of it as a locked-in purchase price. No matter what happens to the company's valuation in the future, your strike price remains the same. This price is set on the day your options are granted and never changes. Strike price is based on the fair market value, or FMV, of the company's stock on the date your options are granted. Once it's set, it's locked in permanently and never changes. The fair market value is determined through a 409 evaluation, which is a formal appraisal required by the IRS for private companies. This ensures the strike price is set fairly and complies with tax regulations. Let's look at a simple example. You receive stock options with a strike price of $5 per share. This means you have the right to buy company shares at $5 each, regardless of what the market thinks those shares are worth later. Whether the company's stock price goes up or down, you can always purchase at $5 per share when you exercise your options. Here's where strike price becomes valuable. If your strike price is $5 per share, but the current market value rises to $20 per share, you have a built-in profit. You can buy shares at $5 and they're immediately worth $20. That's a $15 profit per share. The lower your strike price relative to the current market value, the more money you can make. However, strike price can also work against you. If your strike price is $20 per share, but the current market value drops to only $5 per share, your options are considered underwater. In this scenario, there's no incentive to exercise your options because you'd be paying $20 for something worth only $5. You could just buy shares on the open market for less money. Here are the key points to remember about strike price. First, strike price never changes once it's set at the grant date. Second, lower strike prices are more valuable because they give you more profit potential. Third, strike price is always set at fair market value on the grant date to comply with tax rules. And finally, your profit is calculated as market price minus strike price. Understanding this calculation is crucial for evaluating the value of your stock options. Understanding strike price is critical because it determines your potential profit from stock options. When evaluating a job offer or deciding whether to exercise your options, always consider the strike price in relation to the company's current and future valuation. The strike price is your baseline cost, and everything above that represents your potential gain. Make informed decisions by understanding this fundamental concept of startup equity compensation.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.